I think the shocker to a lot of people is we've entered here in 2025, and the Fed Atlanta's GDP Now indicator suggests that the first quarter will be down in terms of real GDP growth, down 3% at an annual rate from the fourth quarter to the first quarter. And that has unnerved a lot of people because the economy seemed to be doing fine. So now what I'd like to do is talk a little bit about why we probably are in the last phase of this rolling recession.
The Federal Reserve Bank of Atlanta's GDP Now model, a real-time economic forecasting tool that provides a nowcast of the official GDP estimate before its release, recently projected a contraction in U.S. real GDP for the first quarter of 2025. As of March 6th, the model estimates a negative 2.4% growth rate, slightly improving from a negative 2.8% estimate on March 3rd. Several elements have contributed to the GDP Now model's negative projection for Q1 2025. Recent trade tensions, including the implementation of new tariffs on major trading partners, have increased costs for consumers and businesses. This environment has led to a decline in manufacturing sentiment and a slowdown in consumer spending, both critical components of GDP. There has also been a notable spike in goods imports, possibly due to businesses preemptively increasing inventories ahead of anticipated tariffs. This surge negatively impacts GDP calculations, as higher imports subtract from the GDP figure. U.S. manufacturers have reported significant declines in new orders and employment, signaling a potential economic slowdown. The ISM Manufacturing Purchasing Managers Index dropped to 50.3, just above the contraction threshold, indicating stagnation in the manufacturing sector. The projected contraction in Q1 2025 raises concerns about the broader economic trajectory for the year. Experts believe trade policies and tariffs could lead to higher inflation, as increased costs for imported goods may be passed on to consumers. This scenario might prompt the Federal Reserve to maintain or even raise interest rates to combat inflationary pressures, potentially dampening investment and consumer spending. However, for Ark Invest founder, CEO, and CIO Cathie Wood, these concerns will be short-lived. Cathie believes the U.S. economy has been in a rolling recession since 2022, and rather than worsening, the situation has gradually begun to improve and should completely resolve itself in the coming weeks. Cathie does not believe that talks about the tariffs, inflation, or even a recession will continue to take prominence in 2025. Instead, she believes the headlines will be about tax cuts, deregulation, increased productivity, leading to a massive boom in GDP growth and a generally bullish outlook for the U.S. economy in the coming years. As we bring you clips from the latest episode of Cathie's monthly In the Know podcast, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks, and enjoy the video.
We've been talking about a rolling recession since the Fed started jacking up interest rates in 2022. For 3 years, a little more than 3 years now, we believe we've been in a rolling recession, and we're coming to the end of it. So that's the good news. The bad news is we do have to go through this process. Bottom line, however, we think after this initial shudder that the equity markets are going to look through whatever the next 6 months holds in terms of economic activity into a future where we see productivity driving real GDP growth at an accelerated rate in an exciting way. And at the same time, inflation continuing to come down because productivity is going up. Productivity is a powerful antidote to inflation. And we think we're probably on the threshold of some of the most important productivity gains in history. So just wanted to set the stage this way. Before we go on, what is happening in these first 6 months of the year? As you know, there was a lot of hope coming out of the election that we were going to be on our way in terms of the equity markets' health and the broadening out of the equity market as a sign of its health. And it has begun, but as always, 2 steps forward, 1 step back. So let's talk about the 1 step back. In terms of fiscal policy, from our point of view, the most important proposal out there right now is the $4.5 trillion tax cut that did make it through the House. They passed a budget with a $4.5 trillion tax cut in it. And that's in addition to the $1.9 trillion tax cut that is part of the Tax Cut and Jobs Act, TCJA. That was scheduled to expire at the end of this year. And we don't think it will expire. This $4.5 trillion is on top of that. Now, you must be wondering what the heck is going on here. That just sounds like a bigger deficit, a bigger hole out there. Well, those numbers are over a 10-year period. But I think one of the most important things we're learning is that the tax rate cuts themselves will be retroactive to January 20th. Now, that's not cast in concrete at all, but we have heard in and around the administration talk of retroactive tax cuts. Why is that so important? Well, we learned from the Reagan Revolution that phasing in tax cuts is a recipe for a very deep recession because people and businesses defer economic activity in order to capture the lower tax rates. And so I think this administration has learned from the Reagan administration that phasing in is not a good idea. So that is very important in terms of information. The Senate version of the budget is not out yet, and then we'll have to go through a reconciliation. I think what's so interesting about the way that President Trump has set this tax cut up is in terms of what people know is going to take place, and I think the president repeated it in his session to Congress this week, no taxes on tips, Social Security, or overtime. Now, those tax benefits are very appealing to the lower and middle class, which tends to benefit from those 3 sources of income. And so President Trump and team cannot be accused of favoring the rich. I think the other thing we're going to see here is that the threats and actual reality of tariffs, which is causing a lot of consternation. I do not like tariffs. They are tax increases. But I think that the president, and we'll get into this when we go through the charts again, the president is hearkening back to the early days of our country, where tariffs actually supported the government. The primary source of income for the government way back then was tariffs. And then, of course, today, tariffs account for very little funding of government spending, and income taxes account for most of it, business and consumer.
Cathie believes that ongoing discussions about tariffs are part of a broader strategy to pass tax cuts, much like those we had during Trump's first term. We need to look at Trump's past tax policies to understand this. During his first administration, his major economic victory was the 2017 Tax Cuts and Jobs Act, which significantly lowered corporate tax rates from 35% to 21%. This move brought the U.S. from one of the highest corporate tax burdens in the world to the bottom quartile among developed nations, making American businesses far more competitive globally. At the time, Trump framed this as just the first step. His goal was always to follow up with deeper tax cuts, particularly for individuals. Now Cathie Wood suggests that Trump's renewed focus on tariffs could be a means to an end. Tariffs generate revenue for the government, and that added income could be used as leverage in budget negotiations to justify tax cuts. By increasing tariffs on foreign goods, Trump might argue that the additional revenue offsets the need for higher domestic taxes, making it easier to push for reductions in income tax rates without drastically increasing the deficit. Cathie interprets these signals as a clear indication that Trump's long-term vision remains centered on reducing taxes, making the U.S. tax system more growth-oriented and competitive. But beyond just policy, this strategy is about reviving economic confidence. Cathie refers to what economists call animal spirits, the surge of optimism that drives people to invest, spend, and take financial risks. Lower tax rates mean individuals and businesses keep more of their earnings, which can lead to increased hiring, higher consumer spending, and stronger stock market performance. This kind of momentum can create a self-reinforcing cycle of economic expansion, where optimism fuels investment, leading to more growth. Let's get back to the video.
So now what I'd like to do is talk a little bit about why we probably are in the last phase of this rolling recession. And it is Employment Friday. I'm not going to spend a lot of time on the January employment report. It's January. There's a lot of, the February employment report. There was a lot of bad weather, a lot of distortions. But if I can give you a few statistics from other reports that have come out recently on unemployment, the Challenger survey shows that layoffs are up more than 100% year over year. This is a very volatile series. But in terms of actual numbers, I think in February, the number was 172,000 layoffs. And if you look at in the context of history, pre or since COVID, that number was in the 50 to 60,000 per month range. So that's a tripling. And then just to compare it to other recessions historically, in 08 and 09 and also 01 and 02, we got to a peak in terms of layoffs of 240,000. So this is getting awfully close to those. In COVID, the peak was understandably 400,000. I don't think we'll get anywhere near there, but that 172,000 put in perspective to 08, 09, and 01, 02. That was the financial crisis and the tech and telecom bust. It says the layoffs are getting up there. We'll also see in the National Federation of Independent Business report next week an indicator showing renewed weakness in employment, where the small business sector has been extremely weak for the last 3 years and is relapsing after a little bit of excitement after the election. We saw the ADP report. It was subpar, 77,000. And the only other thing I'll point out from this report today, government in total did add 11,000 jobs. More than all of them were at the state and local part of the government sector. The federal government lost 10,000 jobs, and we think that number is going to mount considerably. If we're taking a step back and trying to figure out why consumer and business confidence is falling now again, it's because there is a lot of fear associated with this transition from one administration to the other, and and some feeling of chaos. And that's the art of negotiation. So we're taking that as such right now. But if you look at all government employment, so federal employment is less than 2% of the employment in the United States. But federal, state, and local combined is closer to 25%. And then you have quasi-government in education and healthcare. And you're talking about a third of the labor force. And so a lot of people are probably wondering, is my job at risk, or is this move shifting spending from the federal sector down towards the states going to help me? So uncertainty certainly is the watchword. The reason education and healthcare are important is if you look over the last 12 months, those two sectors have been responsible for, I think it's 95% of employment creation. And that's a 12-month moving average, but 95%. In the early days of the last administration, those two sectors accounted for only 10% of job gains over a 12-month moving average period. So we're paying very careful attention. And then, of course, there is the concern that technology is going to take jobs. AI is becoming so proficient. We know coding jobs are the number is starting to go down. There are, I'm sure, a lot of entry-level positions that are not opening up because of artificial intelligence and other technologies. So there is a lot of fear on the employment front.
Cathie sees a very different economic landscape ahead than what mainstream analysts are predicting. While concerns over tariffs, inflation, and recession dominate today's headlines, Cathie believes these issues are already fading. Instead, she anticipates a future marked by tax cuts, deregulation, and rapid technological advancements that will drive a new era of economic growth. One key element of Cathie's optimism is her belief in deregulation. She argues that reducing bureaucratic red tape will unleash new waves of business investment, particularly in industries like artificial intelligence, biotechnology, and clean energy. According to her, previous regulatory burdens have slowed innovation and made it harder for disruptive technologies to gain traction. President Trump's administration, in her view, would likely prioritize cutting regulations to stimulate entrepreneurship and investment, much like what happened in the early years of his first term. Cathie also emphasizes the role of technological innovation in driving productivity gains. She frequently highlights how breakthroughs in AI, robotics, and automation are transforming industries, increasing efficiency, and reducing costs. She argues that these advancements will not only counter inflationary pressures, but also lead to a boom in economic output, making up for any short-term disruptions from trade policies or geopolitical uncertainty. If these innovations accelerate, as she expects, businesses could see significant improvements in profitability, leading to higher wages, stronger consumer spending, and a more robust stock market. Cathie believes that all these factors, lower taxes, deregulation, and rapid technological progress, will combine to fuel a powerful economic expansion in the coming years. She sees this shift as inevitable, not just a possibility. While many economists warn of stagnation or prolonged uncertainty, she argues that we are on the verge of an economic transformation that could redefine growth in the U.S. economy. But what do you think? Are we heading toward a period of economic resurgence, or will the challenges of inflation and trade tensions continue to weigh on growth? Let us know in the comments below. If you enjoyed this breakdown of Cathie Wood's insights, don't forget to like the video, subscribe to the channel, and turn on post notifications so you never miss an update. Your support helps us bring you more in-depth analysis on the latest financial trends. Thanks for watching, and we'll see you in the next one.